Gold has just done the impossible. Gold has reached a record high, and this isn't just a random market move. While most investors were distracted by the stock market, the world's oldest asset just stacked its biggest rally since the 1979 oil crisis. We aren't just looking at price spike. We are witnessing a global structural repricing of risk. Global prices have now crossed $4,400 per ounce, making this one of the strongest years for gold in decades. With gains of more than 67%, gold has clearly outperformed many traditional assets, including stock markets. This tells us that investors and large institutions are becoming more cautious with ongoing global conflicts and shifts in monetary policy. Many are rethinking how they manage risk in uncertain times. One key reason gold is rising is the expectation that interest rates could move lower in the coming years. The policy direction of the US Fed remains a primary determinant of institutional investment flows into gold. The Fed has signaled the possibility of at least 2 rate cuts in 2026. This expectation is already influencing markets today. Investors tend to act early, and many are moving into gold ahead of any official rate cuts. Lower interest rates makes gold more attractive to hold, and when this outlook is combined with ongoing global uncertainty, it provides strong support for gold at current levels. Another major reason behind gold's strength is rising geopolitical tension across the world. Historically, when global conflicts increase, gold tends to attract more attention as a store of value. Today, several ongoing situations are adding to global uncertainty, including the prolonged conflict between Ukraine and Russia, growing tensions in the Middle East between Israel and Iran, and increasing pressure around Venezuela, having spiked the fears of massive energy disruption. When oil routes are threatened and sanctions are used as weapon, capital flees into physical gold. Beyond investors, one of the strongest forces supporting gold today come from central banks themselves. Over the past few years, central banks around the world have been buying gold at a pace never seen before. Collectively, central banks now hold around 36,000 tons of gold, and gold has overtaken the euro to become the second largest global reserve asset after the US dollar. For 3 years in a row, central banks have purchased more than 1,000 tons of gold annually. Countries are diversifying their reserve to protect against geopolitical risk, sanctions, and financial uncertainty. For example, China has steadily increasing its gold holding as a part of a long-term reserve strategy. However, even at these highs, gold only makes up about 7.6% of their total reserves. India has also taken its gold reserves to record levels. This kind of a sustained institutional demand creates a strong foundation for gold prices, not driven by short-term emotion but by long-term strategy. Looking ahead to 2026, most major institutions remain broadly positive on gold, but with a note of caution. Large banks expect gold prices to remain strong, with some forecasts pointing to new high over the next year. Take a look at these year-end targets. JP Morgan predicting an average of $5,055 per ounce by Q4 2026. Bank of America setting a target of $5,000 per ounce, citing US fiscal debt as the main driver. Goldman Sachs recently hiked their forecast to $4,900 per ounce. HSBC and Societe Generale both are now eyeing the $5,000 per ounce target. That said, not everyone expects a straight line up. After such a sharp rise, some analysts warn that short-term corrections are possible. So, as we move into 2026, gold sits at a crossroads. Strong fundamentals like central bank demand and expected rate cuts remain supportive, but short-term swings cannot be ruled out. One thing is clear. Gold's record high are not just about price, they reflect how the world is reassessing risk, stability, and trust in the global financial system. If this video helped you, then make sure you hit the like button, share the video, and subscribe so you don't miss the next deep dive we are working on. Thanks for watching, and I will see you in the next one.